Chapter 7 will be discussing investments and the income related to them. We're only going to be dealing with 3 of the learning objectives, so we're going to explain how interest income and dividend income are taxed, compute the tax consequences associated with capital gains and losses, and then calculate the deduction for portfolio investment related expenses, including investment expenses and investment interest expense. So when it comes to investments, people generally invest because they want a certain rate of return on their investment. But what they have to remember is there is a before-tax rate of return and an after-tax rate of return. So what this is saying is, let's say you have your savings account and you want a 10% return. Well, if it says right now your savings account will earn 10%, that is your before-tax rate of return. What you have to factor in is the actual money you would receive after tax to determine what your after-tax rate of return would be. And that is all dependent on when your investment income is taxed and the rate at which the income is taxed, because some investment income is taxed at different tax rates. When it comes to investments, we have portfolio income, which we're focused on in this chapter's Learning Objectives 1. Passive income and losses will be discussed in a future lesson. Portfolio income and losses are related to investments in stocks and bonds, savings accounts, certificates of deposits, etc. So that's what our focus is on. Interest and dividends are usually taxable when we receive the income. Interest could be on bonds. So we have 2 different kinds, and you're going to have to jot some notes down as we're going here. We generally have corporate bonds and treasury bonds. Certificates of deposits, which are amounts we put into the bank and have it restricted for a certain time period. If you leave the money in for that time period, you get the interest. If you take it out early, you're usually forfeit and penalized the interest. And savings accounts. So these are your normal investment vehicles for earning interest. Ordinary income taxed at ordinary rates. All interest is taxed at ordinary rates. Unless it's municipal bond interest, then it's not taxed at all. And we've already talked about that. Interest from U.S. Treasury bonds are not taxed by the states, but it is taxed for federal purposes. Dividends are earned on stock, and these are typically taxed at lower tax rates, and we'll talk about that a little later. Let's look at corporate and U.S. Treasury bonds and notes this would apply to in a little more detail. When it comes to these bonds, we're looking at ones that have what we call a stated rate of interest and are being sold at a discount. Let's just back up a second. Remember what a bond is. A bond is a certificate, a contract between a bondholder and the corporation or the United States government. Essentially, the corporation or the United States government is borrowing money from the bondholder. So when the bondholder gives money to the corporation or the U.S. Treasury Department, they are loaning that entity money. The corporation or the U.S. Treasury Department promise 2 things to the bondholder. They promise to pay them interest normally at a stated rate of interest. So this is on the bond certificate. They also promise to pay them back a face value, which is also on the bond certificate. So that's all it is. So we're looking at this from the side of the bondholder. So let's look at an example. Let's say the taxpayer purchases bonds from Corporation A. The bond has a face value of $1,000. So that's what the bondholder is going to receive at the end. They're also going to receive 10% of $1,000 each year. I don't have it in here, but you could add it in for 5 years. For 5 years. They purchased it for $980. So there's two distinct components when it comes to interest income here. The first is the direct component. The money the bondholder will receive, this taxpayer. They're going to receive 10% in year one on $1,000, and that's for a full year. So they definitely have interest income of $100. The other component is indirect. Because this bondholder paid less, they only paid $980 today, and in 5 years they're going to get $1,000, there's another component of interest. And to keep it simple, this is how we would calculate it. We would take the 1,000 minus 980, so the difference, how much less did they pay for it? That's the discount, $20. And then we would recognize interest income each year over the 5 years. So take that $20 in total divided by 5. So not only will they show the $100 of interest that they actually received in cash, but also the $4 that they indirectly received by paying less now and getting more later when the bond matures. So the total interest income would be $104. Now, it's very important to point out that this is when a bond is sold for the first time in the primary market. As you can see there, the taxpayer purchases it directly from the corporation. The book identifies between primary and secondary. That $4 is called original issue discount. And they discuss it in your book, original issue discount, but it is interest income to the taxpayer. Another way a corporation could sell a bond, this is more on the corporate side rather than the government side, is a zero coupon. What it essentially is saying is that they do not promise to pay interest over the life of the bond. So a lot of people say it's a no interest bond, but that's not true. Take a look at this example. Taxpayer purchases zero coupon bond today for $890, and you could put this in there, it's direct from the corporation, so this is the first time the bond is being sold. The face value is $1,000, so essentially the taxpayer paid $890 today to get $1,000 in 5 years. It's kind of like buying it at a discount, right? That discount is really considered interest income, and it would be recognized over the life of not the bond, the bond. As you can see, I added these little PowerPoints in here. So it's $1,000 face value minus the purchase price. The difference is $110. So really, they are receiving $110 in interest income because they didn't pay the full price. But instead of recognizing it all in 1 year, they amortize it or recognize it over 5 years, the life of the bond. So they'll include $22 of interest income each year. So that's what they're discussing on the beginning of the chapter. It's my page 7.2 through 7.4. Before I go to dividends, there's another concept they talk about, which is U.S. savings bonds. U.S. savings bonds, you generally purchase it at one price, say $25. You buy a $50 bond for $25 today. And I think it's usually about 10 years. They mature. So you can then cash it in for the face value, which would be $50. Well, the difference between the $50 that you cash it in for and the $25 that it was originally purchased for is the interest income. So we don't look at it as a gain. We look at it as the interest income on the bond, and that's where it would be reported. Some people can choose instead to figure out how much interest is being earned on that bond as it's being earned, and they could show it each year in their tax return instead of waiting until the end. And that's what they discuss on 7.4. So I suggest you go through the interest income example that's provided before dividends really thoroughly to really get a good feel for that. The next major area is dividends. Qualified dividends are dividends paid by domestic companies or foreign corporations that are held for a certain period of time. In your book on page 7-6, they talk about this. So before we go into this knee deep, dividends are payments of profits made from the corporation to the shareholders. all dividends are first considered ordinary, so they'll be taxed. But certain dividends, if they meet these qualifications, they're from domestic or certain foreign corporations, and they're held by a length of time by the taxpayer, then they will be considered qualified dividends. Now, what's the certain period of time? They are that the owner owns them more than 60 days during the 121-day period that begins 60 days before the ex-dividend date and 60 days after the ex-dividend date. Well, what's the ex-dividend date? The first day on which the purchaser of the stock would not be entitled to receive a dividend. Okay, so the purchaser of the stock would not be entitled to a dividend the day before the date of record. Okay, so when you're buying stock, there's the date of record. If you own the stock on the date of record, when a dividend is declared, you get that dividend. So we look and say, what was the first day that they couldn't own the stock? Well, it's the day before the date of record. So we go 60 days backwards, 60 days forward. The person owning the stock and receiving the dividend had to have owned it for at least 60 days during that 121-day period. And that's what that chart means. If they do, it's a qualified dividend. Now, if you're in the 10 or 15% bracket, you do not pay any tax on qualified dividends. If you're in the 25%, 28%, 33 or 35%, you pay a 15% tax on qualified dividends. And if you're in the 39.6%, you pay a 20% tax. Now, remember we talked about portfolio income and before tax return and after tax returns. What would be the after-tax rate of return assuming an 8% before-tax rate of return? Well, assuming the person's qualified dividends are being taxed at 15%, we would take the before-tax rate of return times 1 minus the tax rate and multiply that out, and you would get 6.8%. So that's the true after-tax rate of return on that investment. That's how you would determine that. And you would do the same with interest. Remember, non-qualified dividends are taxed at normal ordinary rates. So all dividends are considered ordinary dividends unless they meet these requirements. So that is interest and dividends. Now let's talk about capital gains and losses. These result usually from investments that are held for appreciation potential. Stocks, land is considered a capital asset, mutual funds, and collectibles, maybe precious metals, gun collections, coin collections, things of that nature. Bonds are also included there. When it comes to investments held for appreciation potential, while that property is appreciating, there's no tax on that appreciation. If it's held long term, then any kind of gain is usually taxed at preferential rates. Capital losses have special loss rules, and we've talked a little bit about this already. So these types of investments are generally investments in capital assets. Remember, the tax code does not define capital assets. They're defined by exception. So they tell you what capital assets aren't. And so if your asset is not one of those items, then it is a capital asset. The bottom of page 7-7 though gives a great, many examples there. Artwork, corporate stock, bonds, your personal residence, even your iPhone are capital assets. So a capital asset is any asset other than one used in a trade or business, an account or note receivable in business, or inventory. Because those are all business assets. They're not considered in this capital asset method. A sale of a capital asset generates capital gains and losses. Now, you can remove your asset by specific identification. So if you own 100 shares of Facebook stock and you sell 100 shares of Facebook stock, then you can remove it all at once. But what if you bought 10 shares of Facebook stock one year, 20 another year, 30 another year? Which ones do you remove first? Which ones are considered sold? And you can use a FIFO method. You could assume the first investments you purchased were the first ones sold and remove them that way. Remember how to calculate a gain. We take amount realized, so that's the selling price of the stock minus selling expenses like the commission of the broker, and subtract the tax basis. That will result in, if it's positive, a gain. You sold it for more than its tax basis. If it's negative, a loss. If you have held that capital asset for more than a year, it's considered a long-term asset. If you held it for a year or less, short-term, and that's very important. When you have net short-term capital gains, they are taxed at normal tax rates. Generally, net capital gains, net long-term gains, so gains on long-term capital assets greater than net short-term capital losses are taxed at preferential rates, like qualified dividends. So take a piece of paper. I don't have a slide, but just to show you this off to the side, you could write these numbers down. Let's say you sold 2 stocks. Here's your first stock. You bought it July 1st, 2017 for $1,000. You sold it 9/1 of 17 for $500. That results in a $500 short-term capital loss. You only held it for a couple months, and you sold it for more than you bought it at. Here's your second stock. This stock you bought in 1989 for $2,000. You sell it on June 30th, 2017 for $5,000. Subtract the $2,000 from the $5,000, you have a $3,000 long-term capital gain. We don't put on our tax return a $3,000 long-term capital gain and subtract a $500 right on the tax return. No. Since our long-term and our short-term have opposite signs, one's a negative, one's a positive, we net those two together. We net those two together, and the result is a positive $2,500, and it'll take the character of the long-term because the result is a capital gain. So it's a long-term capital gain of $2,500. If you're in the 0 or 10% bracket, you don't pay any income tax on that $2,500 gain. However, if you're in the 25, 28, 33, or 35%, 15% tax on that $2,500. 39.6, you're paying 20%. Okay, so that's what they're talking about there. In future chapters, we'll talk about those other 2 bullets. What if instead you result in a capital loss? So let's switch this around. Let's say that first sale of stock results in a short-term capital loss. Instead of $500, it results in a capital loss of $7,000. So just jot that down. You have a short-term capital loss of $7,000, and you have a long-term capital gain the same year of $3,000. Well, the long-term and the short-term have opposite signs. Net them together. You'll overall have a $4,000 short-term capital loss. Can you take all $4,000 on your tax return? And the answer is no. You can only take $3,000 of capital loss in excess of gain up to $3,000 in a year. So of that $4,000 net capital loss, only $3,000 of it can be taken in the current year. The other $1,000 will be carried over into the next year. Now, we need to discuss, we know how to net some stuff together, but there are steps involved in taxes for netting capital gains and losses together. And it's a 7-step process. First, you should determine all your short-term capital gains and losses and net them together. So combine all of your short-term gains and losses, net them together. You should separate your long-term capital gains and losses into their special groups if you have them. In this chapter, we're generally going to have one, and that's your zero. It's either not going to be taxed, it's going to be taxed at 15%, it's going to be taxed at 20%. But if you have ones that fall into the other groups that were discussed in those other 2 bullet points, you would net those items together in each separate group. Step 3. This provides guidance on how to net the combined long-term gains and losses from each group. So if you do have a group in the 0, 15, or 20%, you do have a group in the 25%, or you do have a group in the 28%, step 3 would give you guidance on how to net them. And this is on page 7-13. Let's look at it. On step 3, if none of the long-term group from step 2 nets to a gain, transfer the net loss in the 0, 15, 20% rate group to the 28% rate group. So everything goes over to the 28% group if it's an overall loss. And then go to step 4. If none of the long-term rate groups from step 2 nets to a loss, go to step 6. Excellent. So it's only if you're coming up with losses. Combine net gains and losses in long-term rate groups. So first, if step 2 results in net losses in both the 28 and that normal percent rate group, combine the net losses and apply them to offset gains in the 25% rate group. You can see this gets very, very technical. Okay, so read through those, and if you have any questions, make sure you ask. Generally, what we're worried about is that 0, 15, or 20% group. They're either going to have 0 tax, they're going to have 15%, or they're going to have 20% tax, because that's what most sale of capital assets will result in. That 28% group is for very specialized sales. And just so you're familiar with it, they're gains from 2 types of capital assets: works of art, any rug or antique, metal or gem, stamp or coin, any alcoholic beverage or similar item held for more than a year, or qualified small business stock held more than 5 years. Very specialized assets there. The 25% group is a very specialized group as well. It's when you sell real estate and you're allowed to tax the gain at 25%. And like I said, we'll talk about that in a future chapter. So they're specialized sales on special capital assets, and that's what sets them apart. And you really just have to read through on how to, when you have long-term capital gains and losses in separate groups, because of the type of long-term capital asset is, very specialized way to net gains and losses among the categories. Let's go to step 4. If there is no short-term capital gain or loss from step 1, the netting process is complete. Apply the net capital loss deduction as described up to $3,000. If the step 1 is a net short-term loss and the result for step 3 is a long-term capital loss, you are done. You don't net the losses together because they're both losses. Remember, before when I was netting groups, the long-term and short-term together, I was saying they had opposite signs. Their net result was opposite. That's not the case here. Short-term loss, long-term loss, they are 2 separate losses. If step 1 produces a net short-term capital gain and step 3 produces a net long-term capital loss, now net those together because they have opposite signs. If the outcome is a net loss, you're done. Deduct up to $3,000 of it. If it's a gain, the net gain is treated the same as net short-term capital gain and is taxed at ordinary rates. So when your capital gain is more, if your short-term capital gain is more than your your long-term capital loss, then when you net it together, you're still going to have a gain and as a short-term character because that was the original gains character. In step 6, if there's no short-term capital gain or loss from step 1, the netting process is complete. You either have a tax on the long-term capital gain remaining in each group at their respective tax rates. If step 1's outcome is a net short-term capital loss and step 3 results in a net gain, you will use your short-term capital loss to offset the gain in any 28% rate group long-term capital gain if you have one, then 25%, and then the 0, 15, or 20% group. So there's a step that you will go through in reducing capital gain. And that's only if your long-term capital gain, you have 3 separate groups. One taxed at 28%, one taxed at 128% because it was art you sold, one being taxed at 25% because it was real estate you sold in your business, or one being taxed at 0, 15, or 20% because it was stock. And that was the order that you would offset. So any gain in the 28% group would be eliminated first, then the 25%, and then that last group, if you have all 3. In step 7, if step 1 produces a net short-term capital gain and 3 produces a net long-term capital gain, then you have 2 separate capital gains, one short-term being taxed at ordinary rates and one long-term being taxed at special rates. So generally, the way you could generally look at this is that when you net together your short-term gains and losses and your long-term gains and losses by category, if the signs are different, you combine them and net those 2 together. If they're the same, you'll have a net short-term capital loss, you'll have a net long-term capital loss, you'll have a net short-term capital gain, net long-term capital gain. The complexity comes in that long-term category if you have 3 different properties in 3 different tax groups because of the nature of the item you sold. So I encourage you to go through the example on page 714 to 715 to really get a good feel, and even into 716, to get a good feel for how these netting procedures work. Let's look at an example though. Ferdinand has the following gains and losses: short-term capital gain 13, short-term capital loss 8, long-term capital gain, we're assuming it's a normal one, no special 28 or 25% bracket, now long-term capital loss 12 grand. What is the amount in character of Ferdinand's gain or loss for the year? Well, first, net the short-term items together. Overall, you have a net short-term capital gain of 5 grand. Net the long-term losses by groups. Well, these were all in one group. It's an overall net long-term loss of 9,000. Step 3A is done. Go to step 4. Step 4 says continue to 5, and now you're at 5 because step 1 results in a net short-term gain and 2 results in a long-term loss. So they're opposite signs. We net those 2 together, and there's only one type of long-term loss here. So overall, there's a $4,000 long-term capital loss. $3,000 of it will be deducted on the tax return. The remaining $1,000 loss will carry forward and retain its long-term capital loss character. Okay, that is my... Okay, limitations on capital losses. There are special rules that apply to the sale of personal use assets, so not investments. Gains are taxable as capital gains. Losses are not deductible. So if you sell your car Cars usually go down in value over time. So if you buy your car for $30,000 and sell it 5 years later for 10, you have a loss. And this is a capital loss, but because it's from a personal asset, not an investment asset, it is not deductible. What if, however, you had a car that increased in value over the time? You bought it for 30 and were able to sell it for 35,000. You have a $5,000 capital gain. And guess what? Even though it's a personal asset, you got to show that gain on your tax return. Capital losses from the sales to what are considered related parties are not deducted in the year of sale. However, the related party may be able to eventually deduct that loss on a subsequent sale of the property. Quick example here. Mom purchases stock for $1,000. A few years later, she sells it to son for $300. Mom has a $700 capital loss. But because she sold it to a person who is considered a related party, her son, can't get more related than that, right? She cannot take that loss on the tax return because it doesn't look like it's a true fair value event. Okay? It kind of just sits out and hangs out, kind of hangs out on the side. When son sells the stock to stranger, okay, let's say he sells it for $2,000. So his selling price is $2,000. He purchased it for $300. So he has a $1,700 gain. However, he is also allowed to deduct that $700 loss that mom was never able to take on that stock. So it's the related party that can use that loss if the gain is enough to cover it. If son subsequently sells that stock for $100, okay, he will have a loss, but he won't be able to deduct that additional amount because it would offset any gain. That $700 loss that was never allowed would be allowed to be offset any gain son has on a future sale to a stranger. So related party losses. Now what if mom sold the stock to son instead of $300, she charged him $1,300? She has a gain. Okay, so this is only applying to losses to related parties because those are generally people you won't sell it to at its true price. Another limitation for capital loss is on something called a wash sale. A wash sale rule disallows the taxpayer to take the loss on stock sold if the taxpayer purchased the same or substantially identical stock within 61-day period centered on the date of the sale. So they look 30 days before the sale and 30 days after the sale. So let's say taxpayer purchases stock B for $1,000 on July 1. He also sells stock BA, which is similar to B. It's almost the same thing, that he has owned for 3 years for $500. He originally purchased it for $700. Okay, so taxpayer purchases stock B for $1,000 on July 1. Let's say on July 15th, he sells stock BA, which is almost the same exact stock as B. He purchased it 3 years ago for $500. I'm sorry, he sold it for $500. He owned it 3 years. He sold it for $500. He originally purchased it for $700. So we're trying to decide, is that sale of stock being sold at a gain or a loss. Well, he sold it for 5, bought it at 7, so he sold it for a loss. But the wash rules say, okay, look 30 days ahead from the sale on July 15th, so that's around August 14th, and 30 days before July 15th, which is around June 15th. Has he bought the same or substantially identical stock? And if the answer is yes, between June 15th and August 14th, he cannot recognize that loss. And it's true here. He bought identical stock on July 1 during that time period, so the wash sale disallows this loss. And that's why they do it. Kim owns 10 shares of Tower with a basis of $40. On December 5th, she acquires 10 more shares for $30. December 31st of year 1, she sells her original 10 shares for $30 a share. Very similar to what we just looked at. What is her loss? What is the basis in her stock? And we didn't talk about that. So Kim purchased Tower stock within 30 days of the date she sold the Tower stock at a loss. So the wash sale provision won't allow her $100 loss from the sale. Instead, her basis in the shares she had bought, remember she bought 10 shares on December 5th for $30 a share, we'll add that loss to the $300. So instead of taking a loss, we'll just say she paid more for that stock that she had bought that disallowed the loss for a future sale. If Kim had purchased the stock November 30th or earlier, or if she purchased the stock January 31st of year 2, she would have been able to deduct that entire $100 loss. It's just because of the time period, 30 days before and 30 days after, she was still doing transactions with that stock, disallowed it. So there's some tax planning strategies we try to tell our clients. Hold capital assets for more than a year if you could. So because they're taxed at better rates, there's $3,000 of offset against ordinary income. So wait and make strategic decisions when selling stocks at a loss. Okay, so you have to balance tax with non-tax factors, of course, because you've got to watch the market. But if you can, try to put yourself in the best tax position. The final area of our discussion is on investment expenses. We focused on how do we recognize investment income? And what's really nice is your book goes through the example and carries it to the tax return. And before I go into investment expenses, how do we report capital gains and losses? On page 7-17, this is our first form we use. It's an 8949, and it's where we give detailed accountings of all short-term capital asset sales and long-term capital asset sales. So on the front side is the short-term sales, and on the back side are the long-term sales. And we're giving detailed information about date we bought it, date we sold it, how much we sold it for, how much we originally bought it at, and overall gain and losses. So we report the details on this form, and then we take the totals from each group and report them on this Schedule D on page 7-19. So part 1 is where we report the total of short-term gains and losses, and in part 2 is where we report the total of long-term gains and losses. And then based on that information, the form actually guides us through that netting process, but so we look at the netting process, but the Schedule D will help you create the proper netting of all capital gains and losses, no matter what short-term, long-term character they may have. Okay, finally, on page 7-25 and on the slide in front of you, you can see there are investment expenses that are directly related to us purchasing investments and keeping them. Things like expenses that we have to pay someone to generate investment income, commissions to brokers. Maybe we have to pay someone for investment advisement. Maybe we have to pay a lawyer to help us with our investments, or an accountant to help us with our investments. These investment expenses are generally deductible as an itemized deduction. They are deducted in a special area of itemized deductions. They're called miscellaneous itemized deductions. And it's only the amount of investment expenses above 2% of AGI that would actually be allowed as a deduction. So just quickly, if you had $1,000 of investment expenses, you paid a lawyer to help you with your investments, okay, and your AGI is $10,000. We say 10,000 times 2% is $200. Well, only $800 of that 1,000, the amount above 2% of AGI, is allowed as an itemized deduction. Okay? Investment interest expense is different. This is interest expense on loans used to purchase these capital assets, these investments. So this is a taxpayer goes to the bank, borrows money to buy stock in a corporation or bonds or a piece of land to hold as an investment. Interest expense on these types of loans are generally allowed as an itemized deduction, but there's a limitation. The deductible amount of interest on these types of loans is limited to the amount of net investment income for the year. Now, what is net investment income? It's your interest, dividends, capital gains, subtract capital losses, minus those investment expenses you took on your miscellaneous itemized deductions. So, let's say you have a loan that you purchased stock with, and the interest was $2,000 this year. So that's your investment interest expense. After netting together your dividends and your interest, your capital gains, your investment income for the year is $1,500. That's how much you showed in those categories overall. But you paid your attorney $300 and took it as an itemized deduction, $300 for advice on your investments. Well, your true amount of net investment income then would be the difference between the $1,500 you showed on your tax return as income from investments minus the $300 in investment expenses you paid to your lawyer and you deducted as an itemized deduction, or $1,200. So of the $2,000 of investment interest expense you paid on the loan to purchase the stock, only $1,200 would be allowed as interest expense deduction. The difference, that $800 difference that was disallowed, you can carry over to the next year. And that's how investment expenses on portfolios work. So take a read through those exercises and stop at and examples and stop at learning objective 4. You could post any kind of questions you may have to the discussion board.